this video, we're going to look at 3 key approaches to investing from the book The Psychology of Money by Morgan Housel, and how you can apply this strategy to build wealth. Hi, I'm Adrian J. Join me as I break down key lessons I'm learning from my reading and research on money, business, and personal finance. If you're new here, make sure you click that subscribe button. Thank you. When it comes to financial planning, there are always variables outside of your control. That's why it's important to have different strategies or options available. This can include setting aside resources to help cushion the impact of unexpected events. By having a plan B, you can be better prepared to handle setbacks and adapt to changing circumstances, which can help you stay on track to achieving your goals. In this video, I'll be covering why it's better to be reasonable than rational. The past doesn't always predict the future. Don't count on your plan always going to plan. Stick around to the end, where I'll share 3 key benefits of applying room for error to your financial planning. Lesson 1. Do not aim to be coldly rational when making financial decisions. Aim to be reasonable. The author illustrates the rational benefits to the body when it has a fever. Fevers turn on the body's immune system to help it fight infection. But it's reasonable to not want the fever because it's unpleasant and it hurts. The reasonable over rational philosophy can also be applied when making decisions about money. People don't want the mathematically optimal strategy. They want the strategy that will help them sleep well at night. You're not a spreadsheet. You're a person. A screwed up, emotional person.
I'm just one big emotion right now.
Harry Markowitz aimed to minimize his future regrets by splitting his investments 50-50 between bonds and equities. By visualizing his grief if the stock market went up and he wasn't in it, or down and he was 100% in it. He wasn't being rational or irrational, but reasonable. The author points out that to commit to an investment strategy over a long period of time, especially when things become difficult, you should make the irrational decision or a more reasonable one to love your investments, such as a company you care about, so you feel you're part of something meaningful, instead of giving up and moving on. A rational investor makes decisions based on numeric facts. A reasonable investor makes decisions based on a partner you don't want to let down, what your friends or neighbors might think, and especially your own personal doubts.
You really want to do this?
Lesson 2. History offers a rough guide to what tends to work, but it's not a map of the future, and it's hard to predict what investors will do next based on what they did in the past. The author points out 2 things that can happen if you rely too much on investment history. Firstly, you could miss major world-changing events that moved the needle the most. A few examples are the Great Depression, World War II, the dot-com bubble, September 11th, the fall of the Soviet Union, the housing crash of the mid-2000s, the global pandemic of 2020, and the current war between Russia and Ukraine. The truth is, we have no idea what will happen next. And the key takeaway when we are surprised by something is to admit the world is full of surprises.
Ooh, that's deep.
Secondly, history doesn't account for structural changes that are relevant to today's world. For example, personal financial advice and analysis for how Americans save for retirement today are not directly comparable to what made sense a generation ago. This is because the 401k is 42 years old and the Roth IRA was created in the 1990s. Personal pensions in the UK was created in the 80s, and the individual savings account, or ISA, was created in 1999. Venture capital didn't exist 25 years ago, so the way companies are funded today cannot be based on historical data from a few decades ago. The S&P 500 didn't include financial stocks until 1976. But today's financials make up 16% of the index.
Seriously?
Technology stocks were non-existent 50 years ago.
Wow.
Investing is not a hard science. It's a group of people making imperfect decisions with limited information about things that will have an impact on their own well-being. This is why it's hard to predict what they'll do next. One of the most famous investors, Benjamin Graham, later admitted that detailed analysis of individual stocks wasn't a strategy as relevant as it was 40 years ago. This is due to competition growing as opportunities became well known, technology making information more accessible to more people, and industries changing as the economy transformed from industrial to technology sectors, which have different business cycles and capital uses. In each edition of The Intelligent Investor, Graham got rid of formulas he presented in the previous edition, basically saying those don't work anymore or not as well as they used to. So the formulas in his 1972 edition, which are outdated today, were used to replace the ones in his 1965 edition, and so on. Since economies evolve, recent history is often the best guide to the future because it's more likely to include important conditions relevant to the future. Historians are not prophets. The further back you look in investing history, the more likely you are to examine a world that no longer applies today.
Makes no sense.
The history of money is useful for learning about people's relationships to greed and fear, how they behave under stress.
Don't stress.
And how they respond to incentives. Specific trends, trades, sectors are always an example of evolution in progress. Lesson 3. By increasing the gap between what you think will happen and what can happen will leave you capable of dealing with the unknowns that are a part of life. The author illustrates how a tiny group of blackjack players who practice card counting demonstrate smart financial behavior by prioritizing the importance of room for error. The players know they are playing a game of odds and not certainties, and therefore bet more when the odds of getting a card they want are in their favor and less when it's against them.
Make a bet, man.
You have to plan on your plan not going according to plan. Assuming you start with $10,000 at a casino, you could comfortably play a $100 unit. Forecasting with precision is extremely difficult, but a margin of safety, according to Benjamin Graham, makes the forecast unnecessary. The truth is, there is a lot of grey in a world that appears black and white. The author states that people underestimate the need for room for error in almost everything they do that involves money. Stock analysts give their clients price targets, not price ranges. Economic forecasters predict things with precise figures, rarely broad probabilities.
Precisely.
The pundit who speaks in unshakable certainties will gain a larger following than the one who says, "We can't know for sure," and speaks in probabilities.
And we just can't say for sure.
The author shares his own strategy using room for error with his investments. Assume future returns earned in your life will be a third lower than the historic average. Save more than you would if the future resembled the past. This is your margin of safety. Have a 1/3 buffer so that if the future is worse than a third lower than the past, you can still sleep well at night. I'll now share 3 key benefits of applying room for error to your financial planning. You're able to endure a range of potential outcomes, which lets you last long enough to let a low probability outcome fall in your favor. For example, having additional savings in cash, which acts as your room for error as part of your financial strategy, lets you endure hardship in another, such as stocks, The biggest point of failure with money is relying only on a paycheck to fund short-term needs with no savings to create a gap between what you think your expenses are and what they might be in the future. For example, having additional savings in cash, which acts as your room for error. There is an emotional safety where having a gap between what you can technically endure on a spreadsheet, such as assets declining by 30%, and being able to sleep at night without worrying about your financial security. Having room for error in retirement savings to mitigate unknowns. For example, future returns are low. Your retirement date ends in the middle of a brutal bear market, or you have to pay for an unforeseen medical emergency. This is the 5th video out of a series of 7, so stay tuned for the next episode. And if you want to check out the book in this video, click the link in the description box below. Make sure you click that subscribe button. And if you have any other book suggestions or you have your own opinions on this book, please leave them in the comments box below. Thank you for your time.